Hey crypto friends, for those of you who are new to my channel, my name is Garrett and welcome to Altcoin Radar. Today guys, I'm going to talk about some of the most important chart patterns that any trader should be familiar with, especially if you are interested in doing your own technical analysis in the future. And guys, before we actually go ahead and get started with the content of this video, if you are interested in trading crypto and you do want to try the same exchange that I use, go ahead and feel free to go ahead and try the MEXC exchange right here. There's a link to it in the description below this video. All right, guys. So as we all know, chart patterns are awesome. All right. Chart patterns and being able to spot trends are an extremely important aspect of technical analysis. But guys, they do require some getting used to before you can actually start using these various patterns effectively, which is ultimately why I'm going to talk about some of the most popular chart patterns that most traders should know. So realistically here, you guys, a chart pattern is pretty much just a shape within a price chart that helps to suggest what the price of an asset might end up doing next, simply based on what they have done in the past, okay? And also, you guys, chart patterns are literally the basis of technical analysis and require us traders to know exactly what we're looking at, as well as what we're looking for as well. Now guys, before we actually dive into these chart patterns, I'd like to touch base real quick on a few different types of chart patterns, such as continuation patterns, reversal patterns, and bilateral patterns as well. So guys, now you're probably wondering what each of these actually mean. So basically, you guys, a continuation pattern pretty much signals that an ongoing trend will be continuing. Whereas a reversal pattern pretty much indicates that a trend may be about to change direction, all right? And lastly, you guys, we've got bilateral patterns. So a bilateral pattern lets traders know that the price could move in either direction, okay? Could either go up, could either go down, meaning it pretty much means that the market is extremely volatile at the time, okay? Now, guys, on a last note here, the most important thing to remember when using chart patterns as part of your overall technical analysis is that they are not a guarantee, okay? So really keep that in mind, because trust me, you guys, I've been in a lot of arguments with people in the past that try to argue with me that they are, they're right all the time and stuff like that. Trust me, you guys, they are not right all the time, okay? They are a lot of times, but they're not all the time, okay? So they are never a guarantee, and don't expect them to be a guarantee, okay? So guys, overall here, you guys, chart patterns are literally merely just an indication of what might happen, okay? So literally they are an indication of what might happen, not what they will happen, okay? So again, you guys, not a guarantee. So guys, overall here though, now that we know a little bit more about chart patterns, now we're going to actually talk about some of the most popular chart patterns that traders use on a regular basis. But don't worry, you guys, I'm not going to talk about every single one out there, okay? Because this video could literally go on for like 2 hours or 3 hours if I did that. I'm literally only going to talk about the most popular 10 patterns, okay, you guys? So with that said, the patterns I'll be talking about in this video are going to be head and shoulders, double tops, double bottoms, rounding bottoms. We're going to talk about cup and handles. We're going to talk about wedges. We're going to talk about pennants and flags. We're going to talk about ascending triangles, descending triangles, and lastly, we're going to talk about symmetrical triangles as well, you guys. So let's go ahead and let's dive into this, okay? So as you guys can clearly see here, I got all kinds of chart patterns ready to go for you guys. So guys, as far as the first one we're going to start out with, we are going to go ahead and start off with the head and shoulders pattern. So guys, this is the classic head and shoulders pattern, okay? Which I'm sure you have probably heard people talk about you've probably heard people talk about head and shoulders at some point in time in the past, regardless, just somewhere you've probably heard about it. But in case you haven't, we're going to go ahead and take a look at this and how this chart pattern actually looks. So basically here, you guys, the head and shoulders pattern is pretty much, it's a pattern in which a large peak, as you guys can see right here, it's where a large peak has a slightly, it's a large peak. It has a slightly smaller peak on either side of it. So here's the smaller one and here's the smaller one, okay? Which would be your head. So this is the head, obviously. It's the larger peak in the center. And then we've got the smaller peaks on the sides, which would be the shoulders. That's how you get head and shoulders, okay? Just like our own bodies. We got the head, peaks up, and then the shoulders that are just kind of, a little bit lower than the head, obviously. So, yeah, I'm sure you can easily picture that. Anyway, you guys, typically what happens here is traders like to look at head and shoulder patterns to predict bullish to bearish reversals, okay, you guys? So typically here, you guys, the two peaks, so the two shoulder peaks here, okay, on either side of the head will typically be smaller than the head in the center, but they will all fall back to the same support level, which is right here, you guys, as you guys can clearly see, which is pretty much called the neckline, okay? So the neckline would technically be the support line for the head and shoulders pattern. So overall here, you guys, head and shoulders patterns are used very frequently. So if you're learning how to do technical analysis right now, then definitely be on the lookout for a head and shoulders pattern that looks similar to this, you guys. And they are easier to spot on stuff like, the 4-hour chart and the 1-day chart and stuff like that. You can get a general overview, a much better, more accurate view of what's going to happen next on the larger time frames, obviously. So but how this works, you guys, pretty much is when used in context with head and shoulders pattern, once this third peak, the right shoulder pretty much, once this third peak falls back and starts heading back to the support level, that's typically when you are going to expect a straight downtrend, okay, or it's going to end up starting a downtrend, okay? That's typically what ends up happening. It's usually a breakout down to the downside, and that's usually what happens with the head and shoulders, you guys. So overall here, like I was saying before, you guys, head and shoulders, they are used very frequently. People find them very frequently, and they are pretty darn accurate when you do find them, okay, you guys? So realistically, be on the lookout for head and shoulders pattern, you guys. Next up, you guys, we're going to go ahead, and the next chart pattern I've got for you guys is going to be the double top, okay? So here I've got for you guys, it's called a double top, all right? And this one is pretty simple and very easy to spot on a chart, you guys. So basically, you guys, a double top is a pattern that traders typically use to highlight trend reversals, okay? Typically what happens here is, an asset's price will experience an initial peak. So it'll experience that initial peak, obviously, and then it'll be followed by a retrace back to the level of support at the neckline, which you can clearly see here, you guys. And then what happens next is, then typically the price will end up climbing up once more again, one more time near the same level as the first peak, and then it'll end up reversing back down permanently like we see in the chart here, okay? It went up, and then it went back down to the support, then it went back up again, and we got this double top right here, this second top, and then it permanently just dropped down past the support line here. So as you guys can clearly see, there's really not much to a double top pattern, as it's, pretty self-explanatory, honestly. So now we're going to actually move on to the next one, which is called a double bottom. So, and I can, I'm sure you guys probably already have some sort of idea of what that's going to look like. So guys, here we've got a double bottom pattern, okay, which is pretty much as the name suggests, you guys. It's typically the opposite of a double top pattern like we just looked at, all right? So guys, a double bottom pattern typically indicates a period of selling, okay, which causes the asset's price to drop, below a level of support, as you guys can clearly see here at the neckline. This is the level of support, okay, when it dropped past that, okay? And what happens next, you guys, is, when the bottom of the trend has exhausted right in here, when it's exhausted, the price will then rise to the level of resistance, okay, which would be right here, the neckline. Now it's become resistance, all right? So it goes up here, then it goes back down and creates another bottom around the same level as the first bottom, kind of like the double top we were talking about, you guys. Anyway, once the price reaches and retests the initial support level again, then the trend typically reverses right here, as you guys can clearly see. It typically reverses and it begins an upward motion, as the market then turns bullish, all right? So basically, you guys, a double bottom is literally a bullish reversal pattern simply because it signifies the end of a downtrend and a shift towards, an uptrend. And that's pretty much it for the double bottom, you guys. So as you guys can clearly see, double bottom and double top and double bottom, pretty much the same thing. They're just reversed, all right? So guys, next up, we've got something a little bit more different. That's called the rounding bottom, okay? Now, I don't know if you guys have probably really heard of this one very much. It's really not It's not too streamlined, I guess you could say, or it's not too mainstream, I guess you could say. But realistically, it is here. So this next chart pattern I've got for you guys, it's the rounding bottom pattern. So it's typically a pattern that can signify both a continuation or a reversal, you guys. And a good example that I can give of this would be to think about an uptrend, okay? Think about an uptrend, and during an uptrend, you guys, the price may fall back slightly before rising one more time. This would be considered a bullish continuation pretty much. Now guys, an example of a bullish reversal rounding bottom, like you see in the chart right here. Now, an example of this bullish reversal rounding bottom, again, like you see in the chart here, would be if the price was in a downtrend, and a rounding bottom formed before the trend reversed and entered into a bullish uptrend, okay? Overall here, you guys, traders will typically seek to capitalize on this pattern by buying halfway around the bottom, typically, at the low point, all right? And by capitalizing, or they will end up capitalizing on the continuation once it breaks above the level of resistance, as you guys can clearly see in this chart. So guys, before I move on to the next chart pattern, if you guys haven't noticed by now, I've mentioned support and resistance. I've mentioned support and resistance levels literally a lot in confluence with each of these chart patterns that we've gone through already. So it goes without saying, you guys, that being able to also spot support and resistance levels is literally equally important, as these chart patterns as well. But don't worry, you guys, I will be doing many, many, many more future videos on support and resistance as well. So don't get too frustrated or anything like that. So guys, now we're gonna go move on to something else that you might already know, which is the cup and handle. All right. So guys, the fifth the fifth chart pattern that I've got for you guys is the popular cup and handle, all right? And as you guys can clearly see just by looking at the example for this one, it looks like an actual cup with a actual handle. So basically, you guys, the cup and handle pattern is a bullish continuation pattern that is used to show a period of bearish market sentiment before the overall trend finally continues in a bullish motion. Now guys, if you notice, the cup portion of the pattern appears similar to a rounding bottom chart like we were just talking about earlier. And the handle portion is similar to a wedge pattern that I'll discuss next. Overall here though, you guys, following the rounding bottom, the price of the asset will likely enter a temporary retracement, which you guys can clearly see here, this temporary retracement. Which is also known as the handle. Because this retracement is confined to two parallel lines on the price graph, and the asset will eventually reverse out of the handle and continue with the overall bullish trend. So guys, as you guys can clearly see here, this one can be a little confusing and it has more context to it as well, but it's definitely one of the more popular patterns out there to look for, you guys. So just keep that in mind as well, all right? So guys, next up, as I was saying earlier, we are going to move on to wedges, okay? So these are wedges, all right? So guys, as far as wedges are concerned, we'll be talking about both rising wedges and falling wedges, okay? And if you aren't familiar with what wedges are, they're typically, they pretty much form naturally as an asset's price movements tighten between two sloping trend lines, okay? As you guys can clearly see. So guys, the first wedge we're going to talk about is the rising wedge. As you guys can clearly see here, they are going upwards, so they are rising wedges, okay? So these are typically represented by a trend line that's caught between two upwardly slanted lines of support and resistance, okay? In this case, though, you guys, the line of support is steeper than the resistance line, and this pattern generally signals that an asset's price will eventually decline more permanently, which, you can clearly see when it breaks through the support level, you guys. Obviously, you can, you can clearly see that there in that bottom portion. So, now on the other hand, you guys, we also have falling wedges, okay? So we'll go ahead and take a look at the falling wedge as well. So this is a falling wedge. Again, it's going downwards, so it's a falling wedge, all right? So with falling wedges, they typically occur between two downwardly sloping levels, okay? And in this case, you guys, the line of resistance is steeper than the support. So overall here, you guys, a falling wedge is usually a clear indicator that an asset's price will rise and break through the level of resistance, like you see in the example that I have right here. Overall, though, you guys, both rising and falling wedges, they're both reversal patterns, okay? With rising wedges representing a bearish market, typically, and falling wedges, being more typical of a bullish market, all right? So guys, it's pretty self-explanatory. You can clearly see it. Once you start to actually see these in real life and you start to actually put them into, I guess you could say put them into your own charts and start to find them on your own, you can really start to see. Actually, you guys, my personal challenge to you guys is to literally go through a chart or go through the Bitcoin chart on probably, I don't know, go through the Bitcoin chart on a 4-hour timeline and literally go back in the history and find one of these patterns somewhere just to challenge yourself, just to see if you can find, how these patterns work. Because once you start to see them in real life and you start to see them working and how they working and what happened next, you'll start to really understand them and you'll start being able to spot them with your own technical analysis, you guys. So guys, now we are going to move on to pennants and flags, okay? So the next chart patterns are pennants and flags, all right? So pennant patterns or flags are typically created after an asset experiences a period of upward movement followed by a consolidation, you guys. Generally, there will be a significant increase during the early stages of the trend before it enters into a series of smaller upward, downward movements, okay? I should also note here, you guys, that that pennants can be either bullish or bearish, okay? And they can represent a continuation or a reversal as well, all right? Now, guys, if you take a look at the example here that I have, you can clearly see it's a bullish continuation, obviously, because it keeps going up afterwards. And in this respect, you guys, pennants can be a form of bilateral patterns simply because they show either continuations or reversals, obviously. So, guys, now, while a pennant may seem, similar kind of to a wedge pattern like I was talking about before, it's literally important to note here that wedges are narrower than pennants or triangles, okay? Like the wedges we were talking about earlier. They are much more narrower than a pennant or a triangle, all right, guys? So really, really keep that in mind because you can really, really, really get those confused. So again, if you're in that position where you're doing technical analysis and you come across what you might think be a pennant, but you also might think it might be a wedge too, and you're not sure, come back to this video or look up both and see the difference between them both, and you'll come to your answer pretty clearly, you guys. So also, guys, the last thing I want to point out here is, wedges differ from pennants simply because a wedge is always ascending or descending, okay? So that is another thing to keep in mind as well, you guys. While a pennant is typically always horizontal, okay, as you guys can clearly see here. So guys, the next one that I'm going to talk about here, or the next pattern I'm going to talk about here, is going to be the ascending triangle, okay? Now guys, as far as the ascending triangle is concerned, it is a bullish continuation pattern, which typically signifies the continuation of an uptrend, okay, as you guys can clearly see here. And guys, it should also be noted that ascending triangles can be drawn onto charts simply by placing a horizontal line along the swing highs, aka the resistance level, and then drawing an ascending trend line along the swing lows, aka the support level, as you guys can clearly see here. This would have been the low, or the swing low, which would be the support level. So you would start the line down here, and this would be the resistance level. As you guys can clearly see here, this would be the resistance point right here, and the line would go straight across up here. And that's literally how you do it, you guys. Now, I should also note that ascending triangles often have two or more identical peaks. Two or more identical peak highs, as you guys can clearly see here. One here. Shit, there's another one there too. There's another one here too. So there's like typically 4 here, you guys, and they're all pretty much identical, very, very close to the same price points. But while the horizontal line indicates the historic level of resistance for that particular asset. So keep that in mind as well, you guys. Overall here, though, you guys, for ascending triangles, they're pretty easy to spot once you start to recognize them in real life or in real time. But next, you guys, we're going to talk about the opposite of ascending triangles, which is going to be the descending triangle, okay? Sorry, I know I'm going a little bit fast here, you guys, and I apologize if it's coming off as, a little bit confusing. But again, you guys, I've realized with YouTube that videos that are over a certain time limit don't really do very well. So I'm trying to go through this as fast as I possibly can so that I'm not dealing with a 30-minute video here or anything like that. So here we are with descending triangles, you guys. So descending triangles signify a bearish continuation of a downtrend. Typically, you guys, traders will enter a short position during a descending triangle in an attempt to profit from a falling market. You see, guys, descending triangles generally shift lower and break through the level, break through the support simply because they are, indicative, of a market dominated by sellers, meaning that successfully lower peaks are, likely to be prevalent, and unlikely to reverse overall. And lastly, you guys, descending triangles can be identified from a horizontal line of support and a downward sloping line of resistance as well. So eventually here, you guys, the trend will break through the support and the downtrend will continue, as you guys can clearly see in this example I've got here for you guys. So now I know these patterns might seem too good to be true, but it's actually really pretty cool, to be on the winning side of them, once you start to use them regularly and get used to them, you guys. So really, really keep that in mind, all right? I know they must be confusing. They were super confusing to me at first as well. But again, once you start to understand them and you start to be on the winning side of using them, you'll feel so good about yourself. It's not even funny. Trust me on this, all right? So guys, lastly, the last charts that I have for you, or the last chart patterns I have for you, are going to be the symmetrical triangles, okay? So guys, we've got symmetrical triangles. These can either be bullish or bearish as well, okay, depending on the market. But in either case, you guys, it's normally a continuation pattern, which typically means that the market will usually continue in the same direction as the overall trend, once the pattern is formed. And also, you guys, symmetrical triangles typically form when the price, converges with a series of lower peaks and higher troughs, okay? Now, guys, in the example I've got for you here, the overall trend is clearly bearish, okay? Obviously, you can clearly see it's clearly bearish. But the symmetrical triangle that you see, the symmetrical triangle shows us that there has been a brief period of upward reversals, you guys. However, you guys, if there is no clear trend before the triangle pattern forms, the market could break out in either direction, which makes symmetrical triangles a bilateral pattern, okay? Meaning they're best used in volatile markets where there typically is no clear indication which way an asset might end up moving, like you can clearly see in this other example that I've got for you right here. There's clearly no indication of which way it's going to go. It could literally either go upward or downward. I mean, you just can't tell, okay? So keep that in mind here as well, you guys. So guys, we've made it through all of those. For those of you who are still with me and still watching this, I applaud you. Seriously, I really do applaud you. I know there's a lot of people on YouTube who have very short attention spans who can't stand watching through a video this long, but hey, I'm all about education and teaching people how to do different things, so I really, really appreciate it if you made it through. But overall here, you guys, I know this was a longer video, but again, I really hope you guys gained some value out of this one. But overall here, you guys, all of the patterns that I explained in this video are very, very useful patterns, which can definitely help you to understand how or why an asset's price moved in a certain way, and which way ultimately, which way it could potentially move in the future as well. And guys, this is simply because chart patterns are capable of highlighting, areas of support and resistance, which can help a trader decide whether they should open a long position or a short position while trading the futures market, or whether they should close out their current open positions in the event of a possible trend reversal as well, you guys. So guys, I know that was a lot to say again, but if you guys have any questions or concerns about any of these chart patterns or anything like that, feel free to reach out to me on Twitter again, you guys. I have no problem answering questions. I love it when people reach out to me. I just love helping people with this stuff. So overall here, you guys, though, that's going to pretty much do it for this video. So I will go ahead and wrap this one up. But again, guys, hey, before you guys leave, go ahead and make sure to subscribe to the channel so that you never miss a new crypto and altcoin video from me on a regular basis. And hey, guys, with that said, thanks again for watching, and I hope to see you guys in the comment section of my future videos.